This is Charles. So without further ado, let's get right into it, shall we? I don't go in and say what is a call and what is a put, but if you want to read my material and really catch on to everything, and we're going to start out a little bit lighter than how the book starts, you got to know what long calls are, and long puts and short calls and short puts. Though this is these concepts, the concept of shorting something, selling something before you own it and buying it back, I would hope that everybody is aware of this concept. So let's just do a little bit of review just to make sure. So I'm going to click this guide right here for the CME PDF that's free. And let's just, called a strategy guide. Let's look at the pages here on the left. And I want to just briefly cover these simple long call, long put, short call, short put, and make sure that we understand them. All right, the concept of long calls is you buy something that is limited risk. That's why it's got this flat limited loss area. The P&L is the profit is above this horizontal line and the loss is below it. And so when you buy it for a premium, if we sit still or go lower, aiming to the left is lower underlying prices, to the right is higher underlying prices, and above is profit and below is loss. We have unlimited gain potential and limited loss potential. That's the concept of a long call. You're buying the right to own the underlying, and you can buy the right to short the underlying in the case of a put by exercising it later if it's in the money, and that shows unlimited gain potential to the downside with limited risk to the upside. Now, obviously, realistically, it's not unlimited gain because the stock can only go to zero, right? But for all intents and purposes, it's like, I mean, if you were short puts in Google and it's trading for over $400 and it goes down $300, you're losing $300. That would be like shorting a call at $400 and the stock going to $700. So short puts, which is shown by this number 8, is it's showing unlimited loss potential if you should sell this put, meaning you win to the upside, but it's a limited gain. Okay, and it's considered unlimited loss. Okay, the nice thing about the CME's presentation is that it talks about the sideways action as well. We know that in options trading, it's not just about up or down. It's not just about bullish or bearish, because one bull spread as the market goes up, a bullish spread rather, will make money, and another one might lose money even though you're right.
Correct on picking the direction.
That's why it's very important to know what you do and do what you know, and stay away from those things which you don't have any understanding about. And it's very easy to get confused with options because they are not so straightforward, as we will see. But I just want to summarize first before we go too far into my book what the theory is trying to express to you by these other free websites. And it's important to start out with the theory of options because they are so unnatural for us as human beings to understand at face value. They're not as straightforward as things we have more experience with in human life. So, and there's a lot of things that are very non-transparent, like one of the earlier examples I give in the book is that a trader came up to me many years ago on the floor. He was a futures trader. He had heard that I was somewhat knowledgeable and came up to ask me my opinion on a strategy that he thought was the bee's knees. The bonds at the time were trading at about 100 a par, and he was talking about buying the futures and selling the 90 call, which was $10 in the money, but had extrinsic premium to it. For example, an extra dollar. So he's selling the in-the-money call for $11, and he owns the futures contract, and it's trading at 100. And he thought, wow, this is free money, because we go up or down a little bit either way, and I'm going to keep that extrinsic value, that extra dollar of the that's tacked on to the in the money amount of the $10, and I'm going to reap that reward. And it seems like a no-brainer because the bonds can't, he said, he thought, go lower than 90. And I want you to know that they can. And but what I said to him was, hold that thought and consider instead selling naked the 90 put. How do you feel about that? And he knew what a short put was and selling one naked, and he said, "No way, no." But it's going for $1. You'll still make $1 if we sit still, won't you? Yeah, but I'm not going to be naked short puts. Well, the trade, and then I demonstrated that the trade was 100% the same play. In fact, what a market maker would do is he would make the trade with this guy, and then he would buy the real put to lock in the profit. In other words, this guy, if the market was it was 11 worth $11, and the futures were trading at 100, the actual bid and ask on the deep in the money call might be 2 ticks under that $11 and 2 ticks over. It's kind of complicated in bonds. They're 64ths, but what that would mean is I'm 1062 bid at 1102. 2 ticks over that $11 and 2 ticks under bid for it. And the put might have had a market of 63 bid at 101, which is 1 tick under a whole dollar, a whole point, and 1 tick over for the ask. And if a market maker got an opportunity to buy on the bid and lock it in with the futures contract, he would own the calls, uh, which he'd be buying 2 ticks undervalued, and he'd sell the real put either at fair value, or if he wanted to just
Lock in the reward.
he could give away the tick to his fellow market makers and sell it one undervalued, and he would lock in a tick, free money, if he was fast enough and didn't hold it and the kind. So the guy had no interest in being short puts. So I then said, then it doesn't really matter about the 90 call and the futures. You don't want that because the part that is transparent you wouldn't want to do, and here's an opportunity to see that it's identical. And the way I'd like to show that example is by using a picture from the book. It's in chapter 6. It's called the Options Matrix, Exhibit 617. And this is what I'd like you to learn, how everything fits into one another. The options are sewn together with these things we call the Greeks, the deltas, the gammas, the vegas, and thetas, which aren't really essential to know. I mean, you could trade profitably without knowing them, but it's my recommendation that you become aware of what they are and what they mean, because the more you know, the better it will be, because there's different opportunities available and the markets become stale. And you can't be a one-trick pony. You have to have lots of tricks, lots of tools in your tool chest to be accommodating for different market conditions. So you want to understand the full landscape. And the reason I teach the landscape this way is because of the transparency. Across the middle you have the strikes. Across the top of the strikes in blue font are the call prices, and below in red are the put prices. And the underlying at this moment is at 100. And that makes sense because the call and the put are the same price. In the futures world, they would be the same price because there's no carry cost. There's no interest to hold the position call minus put because you're taking in as much money as you're giving out. But in the stock world, it's different because of the carry on the stock. You'll see that if you own the call and short the put, that's the same as being long futures. And if it was the same as long stock and you bought that thing, you're not having to spend all the money for the stock, and the market maker who sells you this package will go and buy the stock, and he's got to spend a lot of dough, borrow a lot of money to carry that stock, or lose interest on the cash that he's got by buying the stock, and that implicit interest or that real interest or the average of is built into the call minus the put. And that's what is started to be alluded to in Chapter 1. It's more in Chapter 3 and a lot in Chapter 8, which, by the way, Chapter 8 is a great chapter if you're an insomniac. It will help put you to sleep. It's put in there because there are people who are very thirsty to understand what is it that the market makers know, because they think that the market makers are pulling the wool over their eyes. They think that if this call is 360 that it's a ripoff. But if you think it's a ripoff because it's too high, then be short it somehow. Short it on a call spread some way, or a butterfly, sell two of them and buy the wings. So there's no ripoff here. The market maker will probably be 355 bid at 365 in a very tight and competitive market. What's competitive? Well, there's 6 exchanges that are competing for your orders, and if there's a lot of liquidity, meaning there's lots of buy orders and sell orders, meaning a lot of what we call paper or order flow, two-way paper going in, getting out, people buying, people selling. The market maker, it's easy for him to make money because he comes to work to buy in the bid and sell on the ask and lock in that relationship through understanding this options matrix and doorways that he can go to lock in value. In the first example, I said if you bought the futures at 100 and sold the 90 call, in this case it's 10.50, not $11, you see that that synthetic extra premium is built into the put. In fact, anywhere you look in this line, if you want to know the extrinsic value of the 115 puts, look at the call. There's an extra quarter in there. The 120 puts, there's a dime. There's the 10 cents. So you don't have to do the double math where, subtract out the underlying, figure out what's the intrinsic value. You don't have to do that. You just look at the out of the money options. And what I hope you will be convinced of at the end of this is that calls are synthetically puts and puts are synthetically calls. Now, there's usually a big problem with understanding debit and credit spreads, for example. And I'll just try one, and I'm going to encourage you to answer the questions like you're making a trade. Here's an opportunity to get it right, which represents winning in the market, or getting it wrong, which represents losing in the market. You might be embarrassed by a loser, but it's better to lose it in here when it's not real money than out there on the street clicking away all your money. So take the opportunity to step up to the plate and commit yourself to answering the question in spite of the fact that you might be wrong. Because in the long run, that wrong answer will have more meaning to you if you've tried it. So here's the question I'm going to put to you. The stock is at, let's say 100. And I'm going to buy from you the 105, 110 put spread. It's going for 395. So let's just say you're shorted at 395. You've got a 395 credit. I have a 395 debit. Stock's trading at 100. Both the options are in the money currently. You own the 105 put that's 675, and you're short the 110 put at 1070. The difference is 395 that currently is sitting in your account, and it's a cash balance. And those of you who have big enough accounts, you can actually get interest on this amount of money. So you've generated this credit. You're short the put spread. It's a bullish position. Stock's at 100. Here's the question. Within 5 seconds, ready? What will be the P&L at expiration if we sit here at 100? What will your P&L be after shorting this put spread at 395 and nothing happens, the underlying sits at 100, and time goes by? What's your P&L going to be? Your profit or loss? What's it going to be? Go ahead, put your answer up there. Lose $1.05, Bill says. Is Bill the only one in the options class today? There's 58 people in the room. Rick C., do you agree with Bill at 105 loss? We got a 395. Is that a profit, John? It's a positive number, so I imagine you mean it's a profit. How many agree with John that it's a 395 profit? Punch in a J. How many agree with Bill that it's a 105 loss? Put in a B. So far we got 2 J's. Do I hear another J? Do I hear a B? Anybody got a B? Okay, how many have no idea? Totally clueless. Put a C. Have no idea. Question mark. Howard W. CC. Clueless. Clueless. Fair. That's fair. Okay, clueless. All right. Do you know, for the people who are clueless, do you know what you'd have to do to determine what this is? What calculations you'd have to make? Okay, what are the 105s worth at expiration? If we're at 100, what are the 105s worth at expiration? The 105 puts. What's the answer to that? Rick C, do you know what the 105 puts by themselves would be, or Alex CA? It would be worth 5, right? And we bought it, we're long it on this spread for 675. So on that side, we'd lose $1.75. Correct? Everybody with us there? Have I lost anybody? This spread, the 105 puts are purchased on the spread, and they're purchased at 675 right here, and they're worth 5 at expiration. So far we're down 175. All right, what about the 1070? What's that option, the 110 puts? What are they going to be worth at expiration? All you guys answer that. What are those going to be worth if the underlying? It's going to be worth 10, correct. Okay. So that side makes a profit of 70 cents, doesn't it? So one side loses $1.75 and the other side makes 70, and we lose $1.05, which is Bill's answer. So the 395 is wrong. Okay, now John, this is a huge opportunity for the lights to go on here about the concept of credit versus debit. We get inundated with emails, don't we, about certain spreads to do by these experts and buy their newsletter, and they make 800% return on one trade and this and that. We get those kinds of things. And we also learn that credits are somehow better than debits, right? But here's clearly a case where the concept of a credit over time grows to a difference of $5. Because the 5 that you answered on what the 105 puts will be versus the 10, which is what you said the 110s will be, the difference between the two is 5. And if we originally sold this spread at 395, then it grew to 5. Does everybody see how the 105 is the right answer? Now, I want to express that when I do this credit spread for 395, I immediately say to myself, I am long the call spread for 105. That's how I look at it. I look at the synthetic relationship that's more straightforward. Because if I had asked this question, all right, here's part B. You bought the call spread now. You bought the 105s for 175, and you get to sell the 110s for 70. You're paying $1.05, which is this next row up for the call vertical. You have the bull spread on. You're buying it 105. Underlying's at 100, so it's out of the money. If I asked you after investing that 105, if all the time went by and the options did what they do over time by expiration and we're still at 100, what would your profit and loss be? What would your answer be? Type it in there. You long the call spread, you bought the 105s for 175, you shorted the 110s at 70, you've paid 105. What's your P&L? Put a minus or plus what your answer is. Mini-me, 105 is what? Loss or gain? It's a positive number. Bill says lose 105. Quark says lose 105. Mini-me says make 105. And Rick C, you're sticking with you make 395? Okay. Will the 105 calls and 110 calls be in or out of the money? It's out of the money. Both are out of the money. Both are worthless, right? Will the 105s be worth anything if they're out of the money? If we're trading at 100 by expiration? The answer is no. Will the 110s be worth anything? No. They're both out of the money. Who would exercise the right to purchase the stock or futures at those levels when the stock is much lower and they can own the stock for 100, which is at the market? Why exercise to buy it for so much more? Nobody in their right mind exercises out of the money options unless they know something about a subsequent event, like an inside information or there was an announcement and they still have some time. There's a story about that in chapter 3 about exercising some out of the monies when the Fed cut the discount rate because the cash market was already in the money, implying that they'd be in the money. Bottom line answer here is you lose 105. So I think that everybody understands that the original investment of 105 is worthless, and so the loss is 105. Now, I think you would agree that that is much more straightforward than the first question about selling the put spread for 395. But what you'll come to understand is when you put on certain spreads, whether they're in the money or out of the money, at the time you put them on, and when the market subsequently moves, they will become out of the money or in the money depending on the favorability of the direction. But it's always better to look at the out of the money spread because it's much more straightforward to understand that, hey, debits with out of the monies go worthless over time. Credits in out of the monies go worthless. Out of the money spreads over time go worthless. But in the money spreads, which is confusing to us, grow. So in order to be consistent with the concept of credit and debit and doing what you would think they would do, options are a wasting asset, they erode over time. In order to be consistent with that thinking, we convert our thinking to the out of the money. And we do this with the concept of position dissection, which is what we'll be learning. Here's another one. This is from the preface, asks a question in this purple, and it says, what amount of money is the most amount of money that one can lose? Put up your answer. The Qs are trading at 37.30. The 36 call is going for 170, and the 39 put is going for 190. You are buying 10 of each. You're going to own the 36 call and the 39 put. Now, it's pretty obvious that if the market moves really big, you're going to make some good money because you're long calls and puts, and even though one might go out worthless, the other has a chance of going way in the money and making a whole lot more than the worthless option. Is everybody clear of that concept? That this is a spread. If you're long both of them, you're buying 10 of each. Yeah, it's like a strangle, mini-me. Yes, it's a gut strangle actually. Now I'll ask you, what if we sit still by expiration? What's the amount of money that we're going to lose? What's the most we can lose if we sit still? Go ahead, put your answer up there. Or say clueless. Just respond. Mini-me, the 170 and 190, is that what you can lose, or you'll lose the whole 360? Rick C says you'll lose 300. Bill, you've been getting all the answers right. What's your answer? David says lose 60 cents. John says lose 360. You lose on both. All right, and you're clueless, Howard. Okay, cool. All right, before I go into the answer, I'm gonna give you another question. Okay? Write this down. All right? I'm going to sell you not the 36 call, but instead I'm going to sell you the 36 put. So let's just have the values in front of you. Okay. Everybody should see the underlying at 37.30. I have the 36 calls on the left, puts on the right, and I have the values of each. Now, this time, you're buying the 36 put for 40 cents and the 39 call for 20 cents. You're buying both of those. Is everybody clear? You're still long calls and puts, but you're long a cheap one instead of an in-the-money call. You're long an out-of-the-money put, and you're long an out-of-the-money call instead of an in-the-money put. Everybody clear on the position? Now, the value of that 60 cents and times the 10 it turns out to be $600. So if I asked you if you owned both of these, what's the most you can lose? Real quickly, put your answer up there. How much you will lose if we sit still by expiration. Now look at that. Everybody participated, and it took a couple of seconds, but everybody got it right. Now think about that. That's very important. You didn't learn that here. You didn't learn the answer to that here. You knew this. You get that. You understand this. This is straightforward, isn't it? Well, the other one's not so straightforward, is it? But it's the same answer. It's you lose 600 or 60 cents 10 times, and it's 100 shares. It's $600. Okay, Howard, you're right. 60 cents, $60 per trade. It's 10 of them. It's 600. Okay, the decimal that you're off, you're not wrong about. Okay, but you get the concept. That's the point I'm trying to make about all the options and all the matrix on in the money and out of the money. Okay? Because, and we'll get to it a little later, we're going to learn about this funny red 10 business here, this box trade. Because when we do the blue trade, which was the first question, we're going to change it in our minds to look at it the easy way and see that it is no different than buying these purple 10s, these out-of-the-money options. Now first we have to learn what these funky vertical lines are, and the box tool and the sin tool, and understand why does this work like this. But the truth of the matter about the 10 lots, the blues, they erode over time. But the minimum value of that investment is $3, $3,000. In other words, if we expired right at 37.30, these calls that are 170 today will be worth 130. They only lose the 40 cents extrinsic value. And the 39 puts that are going for 190, they're worth at least 170. They only lose 20 cents, the same 20 cents that's in the out of the money call. In other words, it holds the $3 of value. The in the money amount for the put, the 170 plus the in the money amount on the call, the 130 adds up to $3 because there's an invisible box in there. And we're going to realize that the box tool is very friendly to us. It makes us see so much more. It would make the covered right guy see that his position is a short put. And that would deter him from making trades that he doesn't want to make. If that guy had answered, "Oh yeah, I'd sell puts naked," then I'd shut up. I go, "Yeah, do the call versus the future, no problem." Because if he's got the wherewithal and the bank account, the trading account, to be short naked puts, then let him do it if he knows what he's doing. If he's got a game plan, if he'll pull the trigger, if he'll get out when things aren't right, if he'll cut his losses, all the good rules you hear about in the boot camp lists that you've all gotten by this point in your trading careers. All right? So you're going to apply some of those great trading rules but to options trading, but you got to understand the landscape, and I recommend that you don't touch anything with options until you have a pretty good handle, at least on chapter 1 of the book. Okay? Now, what I'd like to convey to you about the options matrix is that market makers are in the business to get what we call the edge. And they bid and offer below and above a certain value. Now, you know that futures traders do this, and you know scalpers, but it's a totally different game for the options market makers. If these are the fair values, for example, looking at Exhibit 6-17 once again, If these are the fair values, then the market makers surround the values with lower bids and higher asks. So if this is worth 660, he's probably 650 bid at 670. And the next call up, he would be 350 bid at 370. And his markets get narrower as we see the out of the money options. Like the 105s might only be 10 cents wide. If this was futures, it might be 1 or 2 ticks wide. The in the monies tend to carry wider bid and asks. Does anybody know why that would be? Why would the bid and asks be wider for in the money options versus out of the money options? No, not because of no time value. There's less time value, but let's take the 85 calls, Howard, and show you why that's not the right answer. Because the time value in this call that's $15 in the money, the time value is 15 cents. And look at the puts, 15 cents. So they have equal time value. But the call might be, gosh, if this was a stock option, it could be 50 cents wide, but the puts will be a nickel wide, 15 bid at 20 or 10 bid at 15. In a less liquid option, it might be 5 bid at 20 or something like that. It can be ridiculously wide as a percentage of itself. Because they're already worth dollars, because they're already in the money, Alex CA says. More risk. Quark, can you be more specific? More risk? And while you're putting up your answer, and David says delta. There it is, delta. All right, so what is delta? Okay, delta is the rate of change of the option's theoretical value in a 1-point move. And what Quark is saying is if the underlying moves, the deep in the money will change faster. That's exactly right. But the market maker is a pretty nimble guy. He can do all this stuff instantaneously, and he can actually auto quote this thing, and his auto quoting functionality can automatically hedge with the underlying in a nanosecond as soon as he's got the fill on the option. Mini Me says, do market makers make a mistake too? And how can we find it if they do to our favor? They do, but you're not going to find them probably because there's other market makers who will see that mistake faster, and they have software that will scoop up those mistakes, leaving very little chance for you to take advantage of it. The only thing you can take advantage of with market makers is if they are loaded up one way or the other. When I say loaded up, they carry inventory. They carry positions at dozens and dozens of strikes, and sometimes tens of thousands of options will they have in their position. Hundreds of thousands. I've had, and I haven't been a market maker for 10 years, and the market's much bigger. I've had positions of 50, 60,000 options on my, in my statements and my positions. So the guys today, because they're more well-financed than I was, they're all banks behind them. Giant trading firms with 500 market makers working for them, for the same firm. So they diversify, and they'll carry hundreds of thousands of options. They might have 6 market makers trading the same underlying because there's that much to manage. But you might have one market maker managing 25 different stocks or many different futures accounts because of the electronic realm and the ability to do risk management and the ability to have auto quoting and auto hedging where it's done automatically. They're able to manage all this activity. All right, so the answer is that it's a bigger delta, and because of it, it's a disadvantage to you to become counterparties with those market makers and those big in the money options. You will want to stay away from them. So, for example, let's say that you had a bull spread on. Look at this 100-105 spread. The 100s are at the money, the 105s are out of the money. That spread, go up a row, is already mathematically calculated for you. It's 185 difference. So if you own that spread, it's 185. You're risking 185, hoping that the underlying goes in the money. And let's say your wife or husband, if you are the wife, uh, sold the put spread for 315, and she's hoping that that goes out worthless. You'll both make the same money. If the call spread is $5, you'll make the 315, and the put spread would be worthless, and she would make the 315, or your spouse would make the 315 as well. But let's say that when the market goes up, and let's say it goes up $15, that spread that's 185 today will look pretty much like this call vertical that's already way in the money. This call spread is comprised of a call that's $15 in the money and the 90 call that's $10 in the money, and the difference between them is 465, and you have a hefty profit. You've made $2.80, and it's no different than the 315 sale for the spouse, and now it's going for 35 cents. The spouse has a 280 profit, okay? But she's going to get out. She's going to say, I have enough profit. I wouldn't be short a spread for 35 cents that can go to $5. I'm going to take my profit. I wouldn't sell it here, so I'm going to buy it back here. That's reasonable thinking. And you, who have the call spread for 465 now, are faced with having to trade two deeps that are very wide quoted. Why? Because they can. All right? Or because, as David said, the delta's big. Or because Quark said there's more risk. And Quark further expressed that if the underlying moves, it changes faster, right? But I'll tell you one thing, the verticals trade at exactly the same pace. This one that's 465, it moves just as slow as this one that's 35. So what I would recommend to you who has this call spread that has gone up from 185 to 465, I would tell you get out with the put spread. Buy the put spread back. It's narrower. It's easier to leg. You could buy this put for 50 and then later sell the other one for 15. It would all be limited risk even with that legging. Because if you miss selling these at 15, where are they going? A dime? A nickel? Worthless? It's only 15 cents. So some things are worth legging and other things are not. But we'll get into that later. What will you end up with if you own the call spread and you own the put spread? You will own the box. Now, what's a box? The box is something that if we stay in the money, in this case it would be, it'll be worth $5, and you will be taken out of this at expiration through the exercise process. Well, how do you mean? You have $5 in value on the table even though you spent only $2.20 for it, meaning you bought this call spread for $1.85 and now you bought the put spread for 35 cents. Total investment at $2.20. It'll be worth $5. It's worth $5. It's actually worth the present value of $5, but at expiration it will be worth the full $5. The present value, by the way, is probably about $4.98 if there's like 17 days to go or something like that. It depends on interest rates and time. And that's covered in Chapter 3 and more in Chapter 8 about all that stuff. But it's really less than a trading increment, isn't it? That 5 cents or that 3 cents of carrying. It's not worth knowing. But rather than tell you, you don't need to know that, I'm saying you're welcome to know it, and it's in the book, in the full book. But what's going to happen? At expiration, you're going to automatically exercise your in-the-money calls, and you're going to get assigned on your other in-the-money calls that you're short. And what it's going to mean is that you're going to get to buy the stock $5 cheaper than where you're going to sell it. So you're going to make a $5 profit on a stock trade through the exercise process, and there's your $5 that you get. Or you could trade out of it. You could sell it for 5-ish, or they might only give you a $4.95 bid, and if they're really being jerks, they'll say $4.90 bid, but it's free money to anybody who buys it for $4.95, especially if it's significantly in the money like this. And the exercise process, by the way, each option, it's most firms are like $15 per exercise per strike. And so if you only got a one lot in, it's probably better to sell it at 490 because you only lose $10 from the value rather than spending $30 in the exercise process. But if you got a 100 lot on, it's only $30 to exercise versus giving away 10 cents 100 times is $1,000. So size does matter, this particular nuance, and that's just another thing to know about your commission costs. It might be worth it. And what if all of a sudden the market drops big and goes down to 90? Well, then the puts will be exercised and assigned, and you have the right to sell the stock, and you're obligated to buy the stock, and the difference in those sales prices will be an advantage of $5 again when you own the box. So you're going to get your $5, and if it's between them, you'll exercise the in-the-money call and the in-the-money put. If we're talking about the 100s and 105s, and you exercise the 100 call, you get to buy the stock at 100. If you exercise the 105 put, you get to sell the stock at 105, so you'll get your $5. So the box is pretty bulletproof, and there is a problem owning a box when it's right at the strike, and that's called pin risk. But I've run out of time,